Hey, good afternoon, everyone. My name is Sage, and today I'm going to be showing you just some stuff that I've been working on, particularly what's going on in the market, even as I'm making this video. So by the time you watch it, if you do, there is an implication here for exports, specifically out of Nvidia going to China. So they got hit by $5.5 billion worth of a hit. So this is why right now, I'm going to show you on the screen in just a second, why the stock is moving lower by about 5%. So overall, is this significant? I think it actually is. Now, does it necessarily mean that I buy into Nvidia, don't buy into Nvidia? I'm going to share with you a couple levels, and then I also want to share some new, very significant developments of what I've been doing, shifting my focus a little bit more to being quantitative. If you don't know what quantitative is, or if you don't know who I am, maybe you're watching this for the first time. All I ever do and all I will ever do is just share with you my process, so you understand from a mathematical standpoint what we're looking to buy. Because I like to be quantitative. I've always been quantitative. I've always stuck to trade off of data, trade off of technicals. So I am a technical trader, always have been, always will be, but I'm moving a little bit more into the realm of using fast computations in order for me to make decisions. So without any further ado, I know we want to focus on the trades that I took today and focus on what the market is doing. So let's talk about Nvidia right here. This is it on the 5-minute time frame. So price action moves significantly lower right here. So you're probably going to read about this after maybe you watch this video, but a 6% move, more than likely it will recover. But for right now, I have not bought into Nvidia, and I don't want to buy into Nvidia until we get back down into the 80 level. So currently we're sustaining 105, despite the $5.5 billion tag that just got hit by the US government. So they're going to be taxed on exports that they have going out into China. This is a pretty big deal. There was a significant bounce off the 200-day moving average. We got very close, right, to one of my levels. So 85, I want this at 80, I want this at 75. Okay, if we're looking at price to earnings ratio, there's an obvious correlation from here picking up to where we are now. If we're looking last 24 months, it's been picking up significantly on earnings, right? There was one earnings play that I took on this that it jumped 30%. I'll never forget that. That was just a couple years ago. Now time goes by quick, but anyway, it's already pretty fairly decent valuation by the terms of where we trade for valuations nowadays. Back 10, 12 years ago, we didn't really trade at, it wasn't really normal to see 60, 70, 80 times earnings. But the new norm is that the market is exacerbated with liquidity. It really is. There's a lot of liquidity out there. And for every little news pin that's dropped, there's a massive fluctuation of valuation that is either inflated in the market or disinflated. Now, why does this even matter? Why do you even care? You got to recognize the market environment. So as I'm pivoting from my trading strategies and also me as a trader trying to improve, I'm going to look back on this and think 6 months, 12 months down the road, how my evolution worked, right? Because as a trader literally is defined by if you are adapting to the market and if you are adapting to what's going on with everything, right? You can't use the same strategies or the same thought process that you've always used if the underlying or the fundamentals are starting to shift and change. I recognized this 5 years ago. I knew that during COVID, there was a massive amount of liquidity that was dropped because everyone was trading for income, right? That is just going to continually grow. So what does that mean for Nvidia? Right? I'm sharing with you an opinion and some in-depth analysis into why it is I'm doing what I'm doing, but that all is to say that I'm not going to buy at every little incremental point. I'm not going to buy just because something moves up and down 10, 15%, which something like Nvidia, that is massive. That's literally billions of dollars that are moved on single candles. So I'm going to wait a little bit more, right? I like to use something called Fibonacci retracements. If you've never heard of them before, it's basically a computation based off of a ratio, right? So that ratio is a mathematical concept that is significant in nature that a couple years ago we applied it to trading, and we found that there is an interesting correlation when it comes to looking at those ratios at specific points. So without being overly technical, those significant points are going to be 68.1, 78.6, and then a full one-to-one backpedal or retracement back into filling the gap lower. All right, these concepts, they might seem a little bit foreign. Sometimes newer traders like, just tell me up or down, right? It's a little bit more complex than that. There's more nuance when it comes to this. You as a retail trader, if you are trading against professionals, which you are constantly, professional traders are using extremely in-depth and quick quantitative analysis. Quantitative analysis is not new. It hasn't been new for 25 years. It's always been around. So before you look to make crazy, ridiculous decisions, just make sure that you have some sort of strategy or game plan in place. I'm going to share with you mine. On Nvidia, I'm looking for, again, back down to the 61.8 region. It looked like it bounced off that area quite well. That's not fitting narrative into my opinion. That has nothing to do with that. I don't like that. I definitely don't like, because I put real money behind, the decisions and the stuff that I discuss. So if we get back down into this area, there is still overall lower highs if you count from this particular point right here. I don't use trend lines. It's not part of my particular trading style or analysis, but overall, we still have consistently lower highs. And if we break below $89, $85, that's going to be a lower high overall. So breaking below the 200-day moving average on the daily time frame, for me, I'm looking at $75 to $80. Okay, so I don't think that this tailwind, tailstorm, hurricane, whatever you want to call it, geopolitical wind or just momentum shift in the market, which has been massive, I don't necessarily think it's over. I think that we're still in the genesis. So take that for what it's worth. Do your own due diligence, sharing just my opinion. Back down into that area, I'm interested. So what else is selling off, right? I'm looking at a sell-off here on QQQ. Looks like Qs are pulling back into the 450 area. More than likely, you're interested in buying into or maybe plotting a little bit more into the IRA, some retirement accounts, looking more long-term. I'm looking to do the same. I don't have any retirement accounts. Maybe I should at this particular level, but if you're thinking about adding into some positions, probably not the worst time. It's not really going to matter so much exactly what pinpoint value you're looking at if you still have 10, maybe 15 years on the horizon. For those of you guys that are a little bit older, right, don't take this. I'm just a person sharing an opinion. But if you're looking for immediate return in the next 6 months to 1 year, you might be disappointed. So what am I looking at for target areas lower? In my personal opinion, I keep on bringing this up because I think it is of importance. I'm looking for the 5 and the 21 cross once again to hold. Now, if we already broke below the 5 and 21, but there's obviously no continuation. If we use that retracement principle or just that little tactic, right? It's just a technique. That's all it is. If we use that technique, we bounce pretty close to the 61.8 ratio range. We actually got significantly lower than that. So we've traded closer to the threshold of 78.6. So any of these two areas, in my opinion, I say that these are areas that I'm interested in either taking a position again, because I already am in some form or some way of TECL, right, which is a 3x multiplier of QQQ. I would like to add to the position, right? So if I'm thinking, 5-10 years down the road, maybe not a bad area to consider adding. Is it going to matter all that much? I don't think you have to be so pinpoint accurate. The more time you give yourself, the less accuracy you need to have, because it's going to be rounded out with all the noise and the gyrations that exist in the market. If you look at the weekly time frame, so you guys understand what I'm saying, I don't generally draw trend lines. I don't think that they're the best indication of overall market momentum or what have you. But if you draw a medium, right, just crossing where the whole threshold is, we're about at a significant level. The boomers and the people that have the majority of the capital in the market, they're generally looking at the 200-day moving average, and they're also looking at PE ratios. Fundamental analysis is still very prominent in the market, despite the fact that we're using high-frequency trading and quantitative analysis. It's rampant for high-frequency trading and short-term trading. But fundamental analysis is always going to be around. You have to base it off something. The foundation is always going to be the balance sheet. That will never change, ever. It doesn't matter how advanced we get, or it doesn't matter how much AI there is in the market. Okay, so let's get back here to just maybe the 4-hour time frame. I still don't see higher lows. I see maybe one here. So this is right now falling pretty flat on its face, especially with the little pullback that we saw, 1.5%. Many of you are starting to acclimate yourself to high volatility environments. This is very dangerous. This is extremely dangerous because a lot of newer traders, I notice it all the time, even in different groups that sometimes I chime in on just to have my ear to the ground. A lot of people are saying, well, today was a range day. It was a boring day. There wasn't a lot of excitement. That's more, those are gambling tendencies. And I'm not here to gamble. I'm here to be probabilistic, and I'm here to actually make investable decisions. So I'm not really that interested in having, all this price action moving violently every single day. I can get a violent movement. That's okay. But, that's going to be because we're in a volatile situation, which we definitely are. But don't acclimate yourself to high volatility environments and think it's going to be like that all the time. That's not the norm of the market. The norm of the market is when the VIX is below 20. So if you notice, even jumping 11% off the bottom, 12% off the bottom, whatever it was, we're still sustaining above 30 on the VIX. Yes, it did come down from 55, but newer traders, especially people that are now jumping into trading from the first time for the last maybe 2-3 years, you're acclimating yourself way too comfortably in a high volatility environment. That's not good, because when you have those days where you have relatively tight ranges, you get bored, and those are gambling tendencies. You don't want to. Trading is not supposed to be excitable. Neither is investing. It's supposed to be literally boring. That's exactly what it's supposed to be. So the more boring it is, it's because the more based you are on statistics, mathematics, and knowing that something is going to work out for the long term if you give it a good enough data pool. Cool? I know you guys are probably not interested in that, but let me be the voice of reason. If you are buying into high quality companies that actually have value behind them, you will be okay, despite the fact that some of you guys might be down tens of thousands, hundreds of thousands of dollars. Okay. So that's my piece. Let's go here to maybe one more thing that I'm thinking about looking at, daily time frame. We'll throw a fib on here as well. So I want to show you some relative values, and then I'll get into some of the trades that I took today. Let's look at the weekly time frame. This probably is going to give us the best context. We're filling almost completely the gap here on small caps. I'm already bought and allocated into small caps. I'm down, right? I'm being transparent with you. I'm already down on the small caps. However, I don't think that you should write small caps off 100%. The area that I would recommend for you to monitor overall and have a little alert, just like I do, I have my little alerts off to the side. I have a whole bunch of them. Today, 38 of them, it seemed like went off. I had a couple of them that I deleted. All of these are based off the 5 and the 21 cross. So I'm not just telling you to do it. I do it myself because I want to pay attention. So going back to IWM, in my opinion, we trade back down to 160, 165. If that's the case, if that's the end of the world apocalypse scenario, those are some areas that I'm watching. That's the 200-day moving average on the weekly. I think we're already at a significant area. So it's just a watch out below, but also some investable decisions that we have here for longer term. Why are small caps suffering? Well, small caps are the ones that are driving middle America. Right. So these are the businesses that are literally catering to the larger businesses. They're the ones that are taking out the loans. They're the ones that are driving the smaller engines that feed the bigger engines of the American economy. That's not philosophy. It's just how things work. So if small caps are being literally denigrated right now during the current economical climate, we need to make sure that if we're going to do investable decisions, we're not thinking so much about the short term, but also the long term. What are the implications of tariffs and what are the implications of policy right now? Well, we know it's not very good, right? The market is on edge. The market is constantly looking for the next headline and looking for some stability, right? We're not getting it. And I don't think we're going to get it in the short term unless something drastically changes, which I don't foresee it, because past performance or past erratic behavior usually is a pretty good indication of what behavior will substantiate, up until the death certificate per se, right? I don't think anything really is going to change. If I know my current president, he's not going to change at 83 years old. There's not going to be something magical that's going to pop up in his head and then magically have him be complacent and be open to compromise. So I don't see that happening anytime soon. Okay, so what that translates in terms of levels is between 160 to 165. That's basically what I wanted to say. So let's go back here to NQ. Couple positions, you're seeing a lot of things going on. I'll talk about this very briefly. I don't want to bore you to death, but I've made some significant strides in what these arrows are doing and how it is that it's calculating where is a buy and where is a sell signal. All of this is based off of volatility, and all of it is based off of volume. That's all it is. So this is a new implementation, right? This is just a board, or a display, I should say. The display is going to give you real-time data of how the indicator is calculating and pulling information from. So you see that the main indicator has a trend calculation. There's nothing magical about that. The trend calculation is an ATR band. As soon as it hits the higher threshold, if the volatility is running rampant and then moving in a specific direction, it's going to have a look back feature, specifically with volume, but it's also going to use something called a CVD. The CVD is going to be accumulation in one direction or the other. I really like the CVD, particularly because it gives you that granular information real time. It is, in and of itself, it is an oscillator, right? It's just a very granular oscillator, and you got to know how to read it. So when I'm looking at something, slope information is something that for me, I'm finding out real time as I'm talking to you guys how important it is just to see what the slope is, right? Because that slope calculation is going to give you momentum in the market. Because if you're accumulating volume on each little tick, as long as you are sustaining that slope and volatility is moving in the opposite direction where it's contracting a little bit, then you have pretty accurate signals that you can get. So some of you might say, well, it kind of looks like we were all over the place here. Yeah, today was a chop day. Well, kind of not, right? I'm starting to move away from that. I was never a trader that used chop as a cop out, right? For me, chop is whatever. It just is what it is, right? It's this thing. It's this thing that we have to deal with. It's just part of the market. So this is why I generally recommend if you're going to be, trading more long term, the lower time frame you go, the more susceptible you are to noise. So if I have an instrument that is very precise, it's going to give me a lot of precise signals, but you're going to get a lot of noise within the system. So if you look at all these little turns, they're quite precise. It's going to give you every little candle information. But how is this tradable? I can't trade something like this. So I'm not even interested in trading anything like this. This is why for us to do a natural filtration, we want to zoom out of the time frame. This is my recommendation that I'm giving you. Instead of hyper focusing on what the high frequency trades are doing, you're not a high frequency trader. You're not going to be able to compete with the algorithms. I'm sorry, but it's going to compute a lot quicker than you. So a natural filtration is going to be just slightly higher time frame, 5-10 minute time frame. And then you can make actionable decisions based off of this, right? So I'm going to talk about the first trade. The first trade that I took was actually this right here. So depending on if you're in our alpha program or not, alpha program is a coachable program where I'm talking about psychology and I'm just sharing my strategies and sharing how it is that I'm trading the market, what I'm doing, all the implementation. I'm talking about these kinds of things pretty much in depth, and I'm trying to explain to traders, focus a little bit more on your psychology, because your trading is not going to be fixed based off what indicator you're using, or it doesn't matter. What matters is this. What matters is how you think about what you're doing. If you have good psychology and good emotional intelligence, then the decisions that you make on the chart, if you have a good system, then that system is going to pay you very well. You don't have to hyper focus so much on what's going on each individual candle. Focus on the higher probabilities. So in terms of probability, why did this generate here? What did I just tell you? I told you that it's focused on volatility, and I told you also that it's focused on volume, right? So how did I get volume information? Let's talk about slope. Does anyone see a slope there? There's a correlating slope, so I just blew that up. So naturally, you should be asking, well, I probably should have got a short signal right here because there's a slope to the downside. Well, let's confirm here on the signal. It kind of looks like we got a slope there to the downside, right? When we're in a choppy market, there is a way to filter this out, but I'm not going to be trading 3 o'clock in the morning. So I do have a feature now in my personal trading system. Don't think about it as an indicator. Indicator is going to give you very broad strokes. This is a trading system. It literally is a trading system. So if I want to filter out very, very low impact, very low threshold stuff, I can do that, right? I can just put a filter and the filter will look something like that. And I've already done this. I'm just including this here so you guys see exactly how it works. But the filter is going to say, well, if we can't cross above a specific part of the histo, right? I'm not really interested in trades unless they go past this threshold right here. Do you see what I'm saying? So I already have that implemented. If I wanted to include that here, it's very easy. All it is I have to come in here and then I just have to go into my ATR filter, and then I can tag that on, or I can do a CVD filter, right? Because it's using both calculations. So remember, if you know how it works, you know how to optimize it. It's that simple. All right, let me go back. Right? You guys probably don't care about this. You care about good quality signals and how is this going to make me money? I get it. Cool. So let's go back here to the chart. If I'm looking specifically at this slope information, this started to pick it up. Now there's a correlation between the slope and also the volume that is kind of percolating right here on the TTM, right? So let me draw this. That slope information started to pick up right here. Do you see how this is more granular than anything else? So we had a huge spike when the market opened. So most of our trading systems, including mine, right? I'm gonna group myself in this because I've traded like this for almost 12 years, more than that. I'm gonna use the EMAs. This is my control. This is literally my control. So what my control is, I'm basing it, right? There has to be a benchmark. So if we're trading against the S&P 500, am I making more than 10, 12% a year, 7% a year, or am I failing to hit that? So I'm going to generally look to enter this trade right there, dude. That's it, right? Let me draw that in. So I'm gonna take that trade there because that's where the 5 and the 21 EMA cross works. That's my trading system, 9, 13, 8, 13, 9, 21, whatever. That's going to be there. But I was able to identify it 1, 2, 3, 4 candles earlier. 4 candles. That might not mean a damn thing to you. You might say, I kind of don't give a shit. Or if you do give a shit, how did I do that, right? How was I able to do that? Well, I'm going to tell you how I was able to do that. People are asking me, well, how are you calculating these signals? I don't get it. I don't understand how it works. It's just a stupid indicator. It's thinking. It's literally telling you. It's thinking like I would, right? Because I designed it. And how do I think? Well, I'm telling you. I'm looking at that slope information and I'm looking at the average volume with the look back feature. So that look back feature, I forgot to mention this. This would be very important to include. It has this look back feature where it takes the average. You can pick this. It takes the average last 5, 6, 7 candles and is going to calculate just like the CVD does. Is the average accumulation in delta for the last 5 candles positive or negative? If it's positive, then it's saying, okay, it's doing the calculations in the background and saying, well, okay, we've held this candle right here, and then we held the second candle. There's some volatility that's picking up or contracting. It's going to have that inverse relationship, and then it's going to generate that signal. So it's not necessarily saying, it's not telling you, hey, I'm looking back here and then looking at all this price action and I'm deciding what the support and resistance level is. No, it's using the CVD. The CVD slope is the most significant aspect to everything that I'm telling you. So if I do have that slope that is accumulating in one direction, it's going to fire off a signal for a high probability setup. Do you see what I'm trying to tell you? So let's remove here the indicators. Let's remove the drawings. Not all the indicators. Let's remove the drawings. And then I was delayed on this candle. The price action people are going to tell me, well, it doesn't really look that good because you lost some points right here. So I would have gotten into this trade on this first engulfing candle. Some price action people might say that. That's fine. It's fine. That's fine. If you can do that, if you can calculate for that, or if you have your experience that is going to trump everything that I'm telling you here, that's great, right? I don't have that ability. I really don't have that ability. I want to confirm based off the trend threshold, which is the TWAP. I want to confirm that first of all, I'm breaking into that trend or breaking into that potential area of high probability. And then from there, identify that if there is a CVD that's picking up, I want to be able to see it. You see? All right, so that slope did come in. How many points did I catch on this trade? I got in on this candle very close to where the snow line is. So the snow line is just that white little horizontal line. And then I'm starting to push up, right? I'm pushing up, I'm pushing up, I'm pushing up, I'm pushing up, I'm pushing up. And then finally, I took off this trade as soon as this candle started breaking a little bit lower. So I held this trade for approximately about 160 point gain. That's what it was. So I trimmed out the position and then I let my runner just run. As soon as this candle started printing, this got a print before this candle closed, right? So you can't really see that here. But as soon as that had a shift of trend momentum, right? It detected, okay, it doesn't look like we're accumulating anymore. It doesn't really look like we're pushing higher any longer. So I got that information here and then the signal fired. So when this started firing a short, right? When this trend line was broken, I got out of the trade. So how many points did I catch on that? About 160 points. Okay. The same thing right here. There was a huge volatility spike, huge, absolutely massive. So you can see it on this candle and obviously it's reflected on the CVD. So it's going to give you that information. So where do I know to cut this position if I decided to jump out of this trade and then immediately take this trade? Well, the TWAP is going to give you some confirmation, visual cue as to if you want to hold the trade or not. That's up to you. This system cannot. It can't possibly tell you, hey, if you want to hold on to the trade, that's you, right? It's going to give you a visual cue. And then obviously you got a dry signal right here. Why did you get a dry signal? Because look at the CVD. This is not an imperfect calculation. The calculation is correct. It literally is correct. It's telling me, okay, for every spike that we get, both in volatility and volume, I want to be notified of that. It's up to me, the trader, to manage the trade correctly. Okay. So some of you might understand this. You might say, I kind of get it. So if I'm looking to catch breakouts, this probably means that I can catch that breakout because for every breakout situation, there's a volatility spike and there's a volume spike. If that's how you're thinking, then you're thinking like myself, right? Because every single time there is a gigantic move in the market, especially when one that's very quick, this is going to detect that. Now, everything in between that, there's going to be what are called false positives. Those false positives are just inherent in trading. The higher time frame you go, the less susceptible you're going to be to that. So the time frame is a natural filter to that. It's not something that you can perfectly calculate for the shorter time frame. If you are on the back end of this, maybe you are a quantitative trader, maybe you are an institutional trader. Institutional traders they don't have a win rate of 95%, far from it. Their win rates are anywhere between 60 to maybe 75%, but their risk reward is very good and their management of their positions are very good. If they get cut off on something and then they have to flip the switch immediately to the next signal, that's what they're going to do. So they're going to take their stop. For example, I take this trade right here, and let's just say I got in and then I take the stop as soon as we start flipping the switch. I'm going to hold on to this trade because the trend identifier is going to tell me to hold on to it. And let's just say I take the trade off here. Well, maybe I got a break-even trade. Maybe I lost 10 points. Maybe I lost 20 points, but I just came off of a 160-point winner. You see what I'm trying to tell you? All right, so I came off of this trade right here, so I kind of jumped over this one. But let's say I got into this trade here, and then I'm going to hold on to the trade until I'm tagged on that next signal. So how many points did I lose? 6, 10 points? I can deal with that. So 10-point loss, maybe 10-point loss. And then after that, I got this trade right here, right? This is the trade that I actually took. This is the next trade. This is trade number 2. So back down here until I'm tagged on the next signal. I actually got out of this trade when this candle started breaking above. So I called this for 65 points, something like that. Okay. So 65-point trade. So now we're doing risk reward. And now we're looking at what our drawdown is. And specifically, how much am I losing versus how much I'm gaining? It's a business cost. That's what it is. If you're looking at any balance sheet and you understand business, I've owned businesses for pretty much my entire life. If you don't understand the balance sheet relationship, you have to have operational costs, right? Operational costs are just part of doing business. If you understand that, then you can trade quite well. Trading is nothing different than owning a business. It really is. If you understand your costs, what you want to do is you want to try to see how you can minimize that cost as much as possible. This is the whole thing about the trade war that we're going through right now. Minimizing costs as much as possible, yada, yada, yada. This is how it's done. The proper risk management. If you can use proper risk management, you can use a trading system like this and you can be quite successful. It doesn't have to be exactly this, but I'm trying to tell you guys that no indicator, no quantitative analysis, nothing ever will substitute good risk management. Risk management is something that you can code for sure, but it's the onus on you as a trader to identify, where can you cut the position and stop holding on to something just because you think that it's going to do something, right? That's probably the worst thing. And I still struggle with that myself. I'm trying to move away from that because despite the fact that I know that Apple is going to go up or whatever is going to recover, I know that, but I don't need to suffer so much through the drawdown or through the pain because now I'm employing a little bit of a different system. So now you understand why I took certain trades. You understand maybe how collectively I'm thinking about the trades that I'm taking and being a little bit more intentional with, if I take a position, I don't really have extremely high expectations. I really don't. I'm just going to take the position and I'm going to let the probabilities play themselves out. You can use additional layers of confirmation using the TTM or the CBD, which is what I would recommend that you use. But ultimately, it really is about playing probabilities. This caught a really nice short here. So before we got the announcement on Nvidia getting hit by that $5.5 billion tag there, this gave me the trend change 4 candles before. So I'm off the 10-minute time frame. It told me 30 minutes before the drop to take a short position. So this is what I'm talking about. Not every trade that you're going to take is going to be an absolute banger. If you want to filter that out, you can do it on the higher time frames. And this is what I'm currently working on. If I'm going to do it off the 30-minute time frame, how many signals am I going to get that is going to have a lot of noise overall? So am I going to get every signal pinpoint accurate perfect? No, probably not. But I want to get as close to maybe 85% accuracy as much as I can, right? So if I'm looking at the 30-minute signals, right? Why didn't this fire? Why didn't this fire? I want to know. I want to know, was there enough volume information? Is my sensitivity ratings off? This is currently what I'm working on. But overall, I was using a very precise tool on the 5-minute time frame. It's dialed in for that. If I'm going to use the 30-minute time frame, the playing fields and the rules are a little bit different. They really are very different. So let's remove the voodoo line so you guys can see exactly what it is that I'm doing, right? I want to see, if I'm not getting sufficient information, because it looks like right here I got a really nice turn, but that look back feature was telling me, hey, Sage, the majority of the volume was kind of negative, so maybe you don't want to try on that trade. So I didn't try on that trade. Here I did get a signal. Why did that fire and this not fire? These are things that I have to figure out. So what I was explaining to you is, if you understand how your trading system works, then you know how to optimize it. Do you see what I'm saying? So this is the cool part. I'm having so much fun, literally so much fun in trying to figure this out and trying to dial in the features. So when I do actually use this and use this at a high capacity, then I'm like, okay, I can have confidence in the signal because I know what it's detecting and I know what's it's choosing to ignore. Okay, so that was really my update of the things that I'm working on. I'm already working on fixing this problem. So this next version of my trading system, based on some of the implementations and the things that I'm asking for it to pick up, have been substantial. Actually, with this particular indicator right here, I have this this is going to have profiles. So this profile right now is set extremely sensitively. So if I just put the sensitivity rating back down to, up to 1, and then change the profile to be more for swinging or more for balance, you're going to see these calculations start to change. So I already fixed this problem with the current iteration of the indicator that I have, right? The problem has already been fixed. I'm amazed by how accurate this is. This literally blows my mind, right? I want to see if I can get this even better than what I have been doing. Like right here, this should have fired a signal, but it seems like its performance prior to that was actually very good. It was actually very, very good. So I can sit here for 14 hours straight and talk about this stuff because I absolutely love talking about this stuff, and it's so much fun. So much fun trying to figure out a problem and then engineer around it so we can have an actionable result, right? I understand why the people that trade for institutions, why some of them are just obsessively compulsive, because it's so much fun. It's so much fun to use math and so much fun to use algorithms and so much fun to use just computations in order to decipher your problem, right? So that's what I've been doing, and these are my updates. You guys are following my journey real time. Have any questions, please let me know in the comment section. If I explained something correctly, incorrectly, or if something wasn't very clear, just let me know, right? You guys can interact with me, and if you're part of our Discord group, feel free to ask me any questions, right? I'm being extremely open about my process because I want you guys to have confidence, not only in what it is that I'm doing, but also in what it is that you're doing, so you can be a more prepared trader. Thank you so much for watching this video, and we'll give you guys an update tomorrow.